So let's do question number 31 to 40 of this financial management MCQ series. Question number 31 है a company limited A limited has a debt to equity ratio of 1.6 compared with its industry average of 1.4. So what does it mean? So options are the company will never experience any difficulty with its creditors. The company has greater than average financial risk when compared to its peers. The company will be viewed as having high credit worthiness, or the company has been less leveraged. So the answer will be option number B, because debt to equity ratio says the company is over leveraged, or over leveraged means company is having more than average financial risk. Question number 32. Which of the accounting ratios will be useful in indicating the falling demand for a product line in the market? Options are fixed asset turnover ratio, average collection period, inventory turnover, finished goods turnover ratios. So answer will be option number D. So turnover ratio is more of an efficiency ratio. So turnover or efficiency ratio should be higher. Higher ratio denominates that there is a rising demand for your stock. That's why your average pile up of that particular stock is very less. Let's understand it with an example. So this is your cost of goods sold divided by average inventory. Then you come to know your inventory turnover. So you say your cost of goods sold is intact. अभी आपका average inventory 100 है और आपका cost of goods sold है 1000. So 1000 divided by 100. So your answer will be 10. Now in this case, if your average inventory it comes down to 50, then what will be the impact? It will be 20. Instead of 10, it will be 20. So it means your turnover will improve if your average inventory stock comes down. So higher is better in this case of turnover ratios. Question number 33. Which of the following statement regarding IRR is true? A project can have only one IRR. If IRR is less than firm's cost of capital, then project should be rejected. This is absolutely correct. So a project can have multiple IRR depending on the cash flow streams. So in the given question, option number 2 and 3 are correct. Answer number B. Answer will be option number B. Let's understand this concept first. For example, this is the stream of cash flows, minus 500, plus 5000 and minus 5000. So if you calculate it, you will come to know that there are two IRRs in this particular given cash stream. So even if you apply this PV ratio of 12.7 or 787.3, your NPV will be 500 only. That is your initial cash outflow. So it means there may be multiple IRR in a cash stream. So in such cases, your modified IRR method should be used. So this is one of the limitations of IRR or even NPV, because if IRR can be multiples, you also witness that NPV is also derived in this through these two IRRs. So NPV is also derived with these two ways. So the solution to this will be modify IRR. I will create a video separate for modify IRR later. Question number 34 says a 15% debenture of face value of 100 of 8 years of maturity is trading at a premium of 9%. Realized amount is 95. Assuming the frequency as one, what will be the yield? So a formula can also be applied, और उसके अलावा what we can do, हम एक सुपीरियर मेथड जो कि है IRR मेथड इटसेल्फ उसको अप्लाई कर सकते हैं. So let's apply that IRR calculation. So in the year 0 you have 109 initial investment, because it's trading at 9% premium. So 109 will be initial investment. If you invest in that particular debenture today, then these are your cash inflows. That is 15% coupon, or at the end 15 plus 95. That is your redeemable value. So 110. So if you solve it through an trial and error method, your IRR will be 12.75%. So the answer will be approximate 12.77%, which is nearer to 12.75. Now here a worth thing to note is an IRR is used to calculate both return as well as cost. Even though the full form of IRR is internal rate of return, but you need to understand the crux. Now if there is an initial outflow and subsequent inflows, then IRR will show the return, because initially you have invested something. On the other hand, if there is an initial inflow and subsequent outflows IRR will show your cost. That in case of cost of capital, because if you raise a capital, it will be inflow at one place, and over a period of time you need to pay for dividend or interest, or at the end of the its maturity you need to pay or you need to redeem it. So that's why it becomes cost. Question number 35. Which of the following represents the maximum growth rate at which the firm can grow by using both internal and external debt without changing the debt equity mix? So the answer in question is sustainable growth rate. Very important question. Now, what is sustainable growth rate? Sustainable growth rate is the rate which represents the maximum growth that a company can achieve without increasing its debt or issuing any new equity. It's a key indicator of company's ability to finance future growth through retained earnings and internal sources. So sustainable growth rate is the maximum rate you can achieve without resorting to new capital. Means it shows your efficient use of your retained earning or internal accruals. Question number 36. Given a debt to equity ratio of 3.2 or 3:2, total asset is 1500 and short-term debt is 300. Assuming that total debt consists of short-term and long-term debt only, what will be the long-term debt? So we have been given the ratio, so let's solve it through an equation only. It has been provided that your debt is 3:2, debt is 3, equity will be 2, and your asset is given as 1500. Means your 3 plus 2 will be 1500. What does it mean? Your 1500 divided by 5 will be 300. So 300 into 3 will be 900. Your 900 will be your debt, and it has been given that your short-term debt is 300. So the answer will be 900 minus 300. That is option number D will be the answer in the given question. Question number 37. The current ratio of a company is 2:1. The company wishes to sell a motor car for cash despite having a slight loss. After executing such a sale, what will happen to the ratio? So after having a slight loss, it doesn't affect your cash. Cash will remain intact even though you sell it at profit or loss. Cash flow is cash flow. Whatever you have received is cash flow only. सो यहाँ पे आपका 2:1 का कैश रेशियो है और आपने मोटर कार सेल किया है. मीन्स आपका फिक्स्ड एसेट को आपने एक नॉन करंट एसेट को करंट एसेट में कन्वर्ट कर दिया. तो मीन्स आपका करंट एसेट बढ़ गया. इट विल इम्प्रूव योर करंट रेशियो. सो द आंसर विल बी ऑप्शन नंबर बी. Question number 38. What does efficient frontier consist of? So options are efficient portfolio, both efficient and inefficient portfolios that have negative correlated securities, portfolios that have positively correlated. So let's understand what is efficient frontier curve first. So efficient frontier curve is a set of optimal portfolios that offer the highest expected return for a defined level of risk or the lowest risk for an expected return. So this is the curve. So your expected return, this is the return, and this is the risk, that is standard deviation, and this is your risk-free rate. So your risk-free rate starts from here, and this is your capital market line, and this is your efficient frontier. So when there is a tangent, this is the optimal point wherein your risk return trade-off is there. You will have a highest return regarding the lowest risk. Otherwise you may have a risk high return at this place also, but the comparative risk will be very high at this juncture. So the optimum point will be this point where risk will be minimum and return will be the optimum. So in this area there will be more risk, in this area there will be more return. This is how you need to understand. So answer will be option number A, efficient portfolio. This will be the answer for the given question. Question number 39. Calculate the return on equity. So net profit margin is 5%, total asset turnover ratio is 2 times, debt to equity ratio is 1.5 times. So dew point chart, you must be remembering that as per dew point chart, your return on equity will be your net profit margin, your asset turnover, your equity multiplier. So in the given case, you have been given debt to equity ratio of 1.5 times. So your debt to equity is 1.5. Your debt to equity 1.5 means your debt is 1.5, equity is 1, asset is 2.5. So total asset upon equity will be 2.5 divided by 1. That is 2.5 itself. So answer will be, in the given question, answer will be 5 into 2 into 2.5. That means 25. So answer will be option number C. So last question of this series. If the effective rate of interest is 10.25% per annum, then what will be the nominal rate of interest provided it's compounded twice in a year? So we know that your effective rate is 10.25, so your nominal rate must be less than it because it's compounding twice a year. So the answer should be 9% or 10%, and by applying logical or common sense it appears to be 10%, but still we need to solve it. So let's solve it. So let us assume the answer will be option number 10. 10. So 10 divided by 2, because it's compounding half yearly, so 10 divided by 2 will be 5%. Now since it's compounding half yearly, so it's powered by 2. The answer will be 1.1025. If we minus 1, reduce 1 from it, the answer will be 10.25. That the answer will be option number C only, because it is giving the answer of 10.25. So option number C is the correct answer.